All right, welcome back. So this is the last session that we'll do about interest rates. So a couple of key ideas here about the risk and term structure of interest rates. These are terms which you'll often see in the financial press. So we'll go through some details around what we mean by the risk structure and what we mean by the term structure of interest rates and what that can tell us about the functionings of the financial system, and also can be used occasionally as leading indicators of the health of the overall macroeconomy, right? So this is the last session that we'll do on interest rates before we move on and start talking about the stock market valuation, and about the rest of the financial system. So we'll talk briefly about foreign exchange, and then we'll go on and talk about the central bank and how the monetary system of the United States is organized. And as we laid out, the end of the course, we'll talk about the three major crises that we would like to cover. The crisis of 1907, which basically fomented the formation of the Federal Reserve by an act of Congress in 1912. Then we'll talk about what happened during the Great Depression, and then finally we'll culminate with a deep discussion around the financial crisis. So that's just to give you a roadmap as to what we're doing. So this is the last session we'll do on interest rates, and might be the most important one, because we'll address two fundamental questions that are often posed when we think about interest rates and bonds in general and the bond market in general. The first thing is that how does differences in maturity between bonds affect different interest rates, right? So two bonds which have the same characteristics, the same underlying risk profile, the same issuer, so on and so forth, but based on the differences in when the bond pays off and when it matures and how long it takes for the bond to mature, will have different interest rates associated with them, and we'll talk about that. That's what we'll talk about in terms of the risk structure of the interest rate. Then we'll talk about why bonds with the same maturity, right? The bonds which are issued by the same issuer, which have the same end date, so that the last payment, the last face value payment, the par value payment of the bond happens at the same exact date, but the underlying interest rate might be different. Okay, so we'll talk about both of these things in turn. And as usual, we'll start this discussion by considering a real world situation, right? So in 2016, right, if you look, and this is the case even right now. So this is an example from the book, but if you look at the interest rates on bonds right now, you'll find a similar situation. What we found is that you could earn a lower interest rate on a 3-month treasury bill than on a 30-year treasury bond, right? So these are two debt instruments. Both of them is instruments where you're lending money to the US government. So the US government has the same risk profile in either case. But in one case, there's a 3-month treasury bill, and then in the other case, it's a 30-month treasury bond. So it's the same issuer, just issuing bonds of different maturities, right? At the same time, so that's what was happening in the government bond market. So at the same time, if you looked at the corporate bond market, right, Aflac Insurance was issuing a bond that matured in 2024 and had an interest rate of 10.2% on a corporate bond that matures in the same year as a bond which was issued by AMD, right? So Aflac's interest rate on their bond was 2.5%, and the bond would mature in 2024. And AMD's bond would also mature in 2024, in which case you'd get the par value of the bond again in 2024. But the interest rate on that bond was 10.2%. Right. So these are two bonds issued by different issuers, but they have the same maturity, right? They're maturing at the same time, but they end up with different interest rates. And the question is, why are there so many interest rates floating around the economy? What explains the fact that there's differences in bonds where the bond is issued by the same issuer but has different maturities and consequently has different interest rates? That's the first case. And then the second case, these are bonds with the same maturity but issued by different entities, and they end up with different interest rates, right? And that's basically what we'll try to explain with theoretical understanding, and also leverage some of the things that we've learned about the bond market in the previous session, right? So at the center of this discussion, if you want to tie it back to policy discussions, in the aftermath of the financial crisis of 2007 2009, fresh sets of questions were raised about the role of what we call bond rating agencies in the economy, right? So, what we found when we'll talk about the financial crisis in more detail, and I've already alluded to this in the past, is that when bond ratings agencies basically take a look at a bond issue and give a grade on it, right? So they, based on what the risk profile of the bond could be, they issue a grade. So AAA is the platinum plated bond security, which is as safe as it can get. That's the highest rating you can get. And then we'll look at the ladder through which the ratings fall. So as the ratings on the bonds decline, the underlying theory is that the bonds might have a lot more risk associated with them, right? And what they found during the height of the financial crisis was these bond regulating agencies were issuing a lot of questionable bond products, a lot of synthetic security products with very high ratings, even though when on closer inspection, that should not have been the case. And that opened up this entire discussion around should bond agencies be more closely regulated by the government? And that's what we'll try to answer by the end of all of this discussion. Okay. So before we get into all of that, let's first consider the first situation, right? Bonds which have the same maturity, so they're both sets of bonds which mature on the same exact date. Why do these bonds have different interest rates? Okay, and we have a lot of academic research on this question, and we come away with four different explanations, and together they form a coherent explanation for why bonds which mature at the same time might have different interest rates. The first obvious answer is risk, right? In our opening session, when we talked about AFLAC versus AMD, where AFLAC was able to issue their bond at 2.5%, but AMD had to pay an interest of 10.2% on their bond issue, the question becomes, okay, maybe the differences are because AFLAC is less risky as an insurance business than AMD is in the semiconductor business, right? So that's the reason why the risk profile of the bond issuer might play into at what interest rate they can enter into the bond market and raise money, right? So risk is the obvious answer, but that's not the end all answer. That's the intuitive and the most fundamental answer for why different bonds which mature on the same date might have different interest rates. It basically comes down to differences in their risk profile. But there's other things that have been well studied in the literature. There's concerns around liquidity. So we'll take each of these in turn. There's concerns around information costs, and we'll briefly turn into how government policy intersects with this issue by considering what taxation has to say about this. Okay. So when we talk about the risk structure of interest rates, what we are considering is the relationship among interest rates which have the same maturity but have different characteristics, right? So uh, here, let me get a pen. So when we talk about the risk structure, when you hear this term, what we are talking about is bonds which have the same maturity. So at the end date of the bonds is the same, but they might differ in the underlying characteristics of the bond issue. Okay. All right. So let's first talk about risk, right? And the biggest risk as a bond issuer, when you're lending an entity money, the biggest risk you have is the failure to repay that money, what we call default, right? So the default risk, or what is also sometimes referred to as the credit risk, so these terms you will see used interchangeably often. What we mean by that is the probability that a bond issuer will fail to make payments on the bond, either fail to make the coupon payments that are owed at periodically, or default completely on the principal which is owed on these bonds, right? And the question then turns into, how do we measure default risk, right? How do we come away with a measure of default risk? So the most commonly used measure is to look at the difference, the spread, as we say, in interest rates between a corporate bond, right, between the interest rate on it could be a corporate bond or a bond issued by any other company, and what the safest interest rate in the economy is, right? So now if you think about a treasury bond, the treasury bond is as safe as you can get, right? A treasury bond is issued by the US government. It's backed by the full faith and the credit of the United States government, and you can be fairly assured that the US government is not going to default on its credit obligations. So we look at the interest rate that you would earn on a similar maturity. So if it's a 10-year corporate bond, so let's make this things concrete. Now you go into this market and you look at the 10-year treasury bond. You'll observe what the interest rate on that bond is, obviously. So you know what the interest rate you would get on a 10-year treasury bond is. Then you would go and look at a corporate bond. Let's say Apple has a 10-year bond issue. So you look at the interest rate they're offering. The difference between what interest rate you would earn on the safest asset, which the safest bond, which is a US Treasury bond of the same maturity, versus what you would earn on a bond which has the same maturity but issued by a different entity. The spread between those two interest rates is what we call the default risk premium. And the argument is fairly straightforward. The argument is that the difference in interest rates is compensating for the additional risk that you're carrying by investing in the corporate bond rather than in the treasury bond, right? So that spread, the additional yield that you're getting on this corporate bond is because it's a riskier enterprise, and investors need to be compensated for the additional risk that they're carrying on the portfolio by investing in the corporate bond rather than the treasury. Okay. And these default risk premiums are usually calculated by these credit ratings agencies, and then they grade them on their credit worthiness, right? On the credit rating agencies rate both issues by governments, by government bonds, and also by corporations, right? So bond rating is a way of just capturing all of this information in one single statistic, right? So when you look at the bond rating issued by a rating agency, you can pretty well tell on what rung of risk does that bond lie on. And here I have uh, the ratings that are commonly issued. So there's three big ratings agencies in the United States. Moody's is one, Standard & Poor, which is S&P, and Fitch Ratings, right? So now, based on the credit default premium that the bond has relative to a similar maturity treasury bond, grades are issued on the creditworthiness of the issuer. So a AAA rating essentially is highest credit quality, right? Is like if you want a more concrete example, this is equivalent to an individual's credit score, right? So once you have a credit card open and you build up credit history, you're given a credit score. FICO does a credit scoring for individuals. So you have a credit score, and that tells potential lenders what your credit worthiness is. It keeps track of your track record of payments on time, how much credit you're using, what your underlying income and other dynamics look like, and issues a number which tells lenders how creditworthy you are. Similarly, for the bond market, there's these three big agencies: Moody's, Standard & Poor's, and Fitch, which issue these ratings. So if your bond issue has a AAA rating, that's basically the highest credit quality. And then it goes down. So AAA, AA, A, BAA, BA, B, and that's the end of the investment grade bonds, as we say, right? BAA on the Moody's. So there's a difference in terminology. So Standard & Poor's and Fitch have the same kind of grading thing. So they go AAA, AA, triple B, double BB, triple C, double C, and so on. So they have the same kind of rating um, scale. Moody's has a slightly different thing. So instead of having a B triple B, instead of having the triple B rated bond, we have BAA. Right, so a BAA on Moody's is the same as triple B on either Fitch or Standard & Poor's. But that's kind of a semantic difference, which doesn't really matter all that much, but it's something to keep in track of, right? So just to make sure that you know where you're at. So anything which is rated triple B or higher, so I'm just going to stay with the S&P kind of framework because that's a more commonly used framework. So anything which is rated triple B or higher is treated as investment grade, right? So as you go down these ratings grade on these ratings which are given by these agencies, the risk of the bond issue keeps getting worse, right? So triple B is considered good credit quality. So as there is like, a credit score of 800 on 850 is considered excellent, so that you could consider to be triple A. A credit score of 780 or more, or for an individual is very high credit quality. So that's like double A for a corporation, and so on and so forth, right? So beyond triple B, everything beyond triple B rated is basically in the territory of speculative bonds. These are very risky bonds, and this is also usually referred to as the junk bond market, right? These are bonds which have very high risk of default associated with them, and only very sophisticated investors who have a handle on these things usually try to venture into these markets, right? All right. So let's consider a situation, right, as to how we determine the credit spread. Okay, how do we determine the default risk premium on any given bond issue? All right. So suppose, so in order to calculate the default risk premium, understand that we need to consider two markets simultaneously. We need to consider the treasury market of a bond with the same maturity, and we need to consider the bond market of the same maturity. So here we have a case where on the right hand side in panel B, we are considering the market for treasury bonds, and on panel A, we are considering the market for a BAA corporate bond, right? So this is the lowest end of the investment grade spectrum. Now, suppose the risk profile, suppose the default risk, if I want to give you a classic example, suppose it's an airline company at the start of the pandemic. And the airline company at the start of the pandemic is rated BAA, right? It's a bond issued by Boeing or Airbus or whatever it is, and they're rated BAA as by the bond ratings agencies. And suddenly, the virus hits, everything gets shut down, these airlines become much more risky, and the default risk on corporate bonds increase because there's a huge cash crunch, because at the end of the day, these companies, this corporation needs to generate enough revenue in order to send out these payments to service its existing debt on the existing bond issues it's already done. As the default risk on these corporate bonds increases, what do we expect to happen? The demand for these bonds needs to decline. And that's represented here by leftward shift in the demand curve instead of from D corp 1, right? So the initial equilibrium in this market was where the supply curve of this corporate bond and the demand curve for this corporate bond met. So the price of the bond, equilibrium market clearing price of the bond was P1C, right? And if straight away, if you know P1C, from our earlier discussion that you immediately know the interest rate associated with the bond, immediately the yield as well, right? All right. So as the default risk on corporate bonds goes up, the demand for these bonds goes down. People don't want to be invested in these risky bonds. So the demand curve shifts to the left and the market goes into equilibrium at a lower price. A lower price on a bond, always recognize, indicates that there is going to be a higher yield on that bond. Okay. Going back to just the bond pricing equation, you're buying the same set of cash flows at a cheaper price, which means that the yield on the bond is going up. Okay. So now the market goes into equilibrium at a lower price and at a higher yield in the corporate bond. At the same time, there is a flight to safety, right? So as things get more turbulent, investors are panicking a little bit and they don't want to be invested in a lot of very risky enterprises. So there is a big chunk of all these people who are buying these BAA corporate bonds. They might shift into other bond markets. Here we are assuming there's just two markets. Either you're in the BAA corporate bond market or you are in the treasury bond market. But usually, investors will move up that scale. So as things begin to get dicey, they might move their positions away from triple B into A or double A or triple A, and they might start to move away from that, right? But in that case, there's going to be a surge in demand for treasuries because they're considered to be much safer. An increase in demand for treasuries is indicated by a rightward shift in the demand curve for treasury bonds, in which case the price of treasury bonds goes up, which means the yield on treasury bonds comes down. So the split in the yield at P2T when the price of treasury bond is at P2T and the yield on the corporate bond when the price of the corporate bond is at P2C, that difference is what we capture to be the default risk premium. Okay. And here, if you look through the empirical data, this is what we find, right? In every time there is a crisis uh, in the economy, and the most glaring example is here. In 2007, 2009, as things got very turbulent in the economy, what do we see? We see a decrease in demand for corporate bonds. A decrease in demand for corporate bonds is indicated by a lower price, market clearing price for these corporate bonds. A lower market clearing price for corporate bonds indicates a surge in the yield on these corporate bonds, right? So the interest rate on these bonds is dramatically increased. At the same time, as things get really choppy in the financial markets, there's a flight to safety and there's a surge in demand for safe assets in the economy, and there's a surge in demand for treasury bonds. If there's a surge in demand for treasury bonds, the market goes into equilibrium at a higher price for treasuries, which indicates a lower yield for treasuries, and that's what we find. This difference, okay, sorry. So the difference between these two curves at any given point tells us what the credit default spread is. Okay, so at any given point, if you look at these two curves and look at the vertical distance between these two curves at any given point, that tells us what the credit default premium is between a corporate bond and an equivalent treasury bond, a treasury bond which has the same maturity. We see similar patterns here during the recession, the short-lived recession of 2001. There's a surge to safety, declining yields on treasury bonds, while yields on corporate bonds begin to spike a little bit. Okay? The recession of 2001 is a kind of an aberrant phenomenon in the sense that it was not a economy-wide recession, though the ripple effects of the recession were felt economy-wide. It was mostly contained in the tech sector. This is the bursting of the tech bubble from the big run up in the 1990s, and the tech bubble burst in 2000, and there's a small short-lived recession spearheaded by the collapse of the tech sector briefly, and that's what we see that causes a mild recession in the United States. Okay. All right. So that's the bond market, the framework we already developed around bond markets and how bond prices are determined and what the impact is on yields now gives us a clean indication of what we expect to happen during times of crisis, how we can explain flights to safety and the underlying decline in interest rates on safe assets, while also seeing a huge uptick in the interest rates on riskier assets in the economy. So that's the big explanation for why bonds, these are bonds which have the same maturity. This is a treasury bond which has the same maturity as this equivalent corporate bond. There are no differences in when the bond makes its payments. The bonds, the corporate bond and treasury bond will mimic each other in their payment structure. The timing of the payments is not the question anymore. Now the difference in interest rate is not guided by timing considerations, it's guided by risk consideration. Okay, so that's the first big explanation we have for why two bonds which have the same maturity will have different interest rates. It's about risk. Other uh, um, explanations that we have is that about liquidity, right? So we look at when we look through the empirical literature, what we find is that investors do care significantly about liquidity. How easy is it for me to exit these positions and turn it into liquid cash as quickly as possible? So if the liquidity is high, if an investment has high degree of liquidity, so if the market is fairly what we call thick and thin markets, right? A thick market is a market which has a lot of volume being traded on a regular basis, which means that it's very easy to find a counterparty to sell your positions to and exit these positions quickly. So if the market is more liquid, as it is the case with treasury bonds, right? It's a very liquid market because everyone is invested. Pension funds are in there, foreign governments are in there, retail investors are in there, your mom and pop investment, 401k investments are also some portion of it is in the treasury bond market. So that's very liquid, right? So the other explanation for why two bonds which have the same maturity might have different interest rates depends on how liquid these bonds are, right? Forget about treasuries for a second. Two corporate bonds, one is Apple and one is some obscure Taiwanese semiconductor company. One market trades a lot more with a lot more volume. The Apple market bond market will trade with a lot more volume than the Taiwanese semiconductor company's bond market will trade. So the interest rate on the Apple bond issue will be slightly lower than what the equivalent maturity bond issue by the Taiwanese semiconductor company is. Even if we think that this risk profile of both the companies are the same, right? If both of them have the same kind of risk profile, but just because of liquidity considerations, the more liquid investment will trade at a lower interest rate than the less liquid investment. Okay. The other explanation that again a lot of time has been spent in academic literature discussing is about information costs. So if it costs a lot of costs a lot of money, time, and effort to understand a particular bond the issuer and their business and their ability to repay their debts and so on and so forth, the higher the information costs associated with a particular bond issuer, the higher the interest rate needs to be to compensate for the fact that there is a increase in information costs, right? Because if information costs are really high, that decreases your bond's expected return, right? So to make things concrete, suppose I have a bond which I can buy for $100 and I'll have $200 in a year and cost me $10 in order to understand this business. So effectively I'll earn $90 on my investment because, I take the $100 and then the additional $10 which is spent, hiring analysts or whatever to do some analysis for me to understand the company, and it's fairly straightforward. Versus a bond which is, again, I can buy it for $100, it'll pay out $200 in a year, but it costs me $95 in order to understand this company because I need like a lot more information. I need to hire a lot more sophisticated analysts to understand this business, so on and so forth. And effectively, I'll only earn $5. So in that sense, the yield on the bond, which has the higher information cost, needs to be higher for you to compensate. You can't just give me $200 when it costs me $90 to understand your company. You need to compensate for the fact that information costs are much higher to understanding your company, and consequently, the yield, the interest rate that you offer on the bond needs to be higher as well. Okay. So like with the risk profile here, which affects the demand for these corporate bonds, any changes to the liquidity profile of the bond and any changes to the information costs associated with the bond issuer, if in either of these two change in a materially significant way, we are going to see an impact in the demand for these bonds, right? You're going to see an immediate impact in the bond market. And as you can imagine, the direction should be straightforward, right? If the liquidity of a bond improves, then there should be an increase in demand for the bonds. If there's an increase in demand for bonds, what should happen? The price of the bond goes up, supply held constant, price of the bond goes up. If the price of the bond goes up, the yield on that bond is lower. So a more liquid bond will have a lower interest rate associated with it. Similarly, if information costs go up for a particular bond, there is going to be lower demand for this bond. If there's a lower demand for this bond, the bond market for that particular bond goes into equilibrium at a lower price. If it goes into equilibrium at a lower price, the yield on that bond, interest rate associated with that price, is going to be higher, right? So that's basically what uh, we have, right? So once we turn into the discussion around the 2007-2009 crisis, what we'll see is that all of these factors come into play to explain why you see this big surge here, right? On the one hand, as a lot of homeowners started walking away, we've had this discussion before, where a lot of homeowners started walking away from their underwater mortgages, and all of these mortgages were bundled together into these mortgage-backed bonds. At this point in time, not only was the risk of these mortgage bonds getting worse because there was a lot of default in the underlying mortgage market, so the risk profile is getting worse. At the same time, the liquidity of the market is drying up because not a lot of people want to trade these bonds. Everyone, it's a seller's market. Everyone wants to exit these positions, and there's not sufficient demand in the market to absorb all of that excess supply. So you are having a second double whammy there. So liquidity is drying up. In the third sense, information costs, because these bonds are now, you need to really sift through the bond to understand what are the underlying mortgages inside these bonds, and it takes a lot of manpower to understand the bond structure. You can't just rely on the credit ratings agencies anymore and on their whatever ratings they've given, because you see that these ratings are flawed in fundamental ways. And then you have all three factors come into play, right? Risk is getting worse, liquidity is drying up, at the same time information costs are going up. That is a triple whammy from which demand for these bonds just collapses. So the demand in the mortgage bond market collapses. As the demand in the mortgage back market collapses, you can see as demand begins to collapse, what is happening to price? The price is starting to is going to nosedive. As the demand curve starts to shift further and further and further and further to the left, you're going to see a huge steep decline in the price of these bonds, which is also associated with a huge uptick in the yield that these bonds are going to generate. Okay. All right. The last thing that we want to understand here is about differential tax treatments. right? So investors don't only care about just raw returns, about nominal returns. They also care about what they'll earn after they pay the taxes that they owe, right? So here's an example. So there's two bond issuers, Ford Motor Company and the US Treasury bond, and they are similar. Okay, Ford will pay out, let's say these are discount bonds. So Ford has a face value of $1,000. So at maturity, it'll pay you a face value of $1,000 and will return a coupon of 6% on that. So $60 coupon before it matures. US Treasury bond, same thing, $1,000 face value, 6% coupon. So the payments are the same in either case. Now, and the maturity is the same. So it's the same cash flow, it's the same maturity, but the difference is in the tax treatment of these bonds, right? So on the corporate bond, suppose the distributions from these corporate bonds are treated at a higher interest, at a higher tax rate. So 40% is uh, so suppose that's the highest bracket of your personal income tax rate. So the distributions from this bond are treated as ordinary income. So you pay the ordinary income tax rate, and suppose you're at the highest bracket of the income tax ladder, so you pay 40% taxes on this. So after taxes, you don't earn $60 as the coupon interest payment on this bond issued by Ford. Instead, after you pay your taxes, so 40% of the $60 is paid off as taxes. So 40% of $60 is $24. So the after tax return is $36. Right. So on this $1,000 face value bond that you buy, you're earning $36 as a coupon payment. So the effective after tax return on this bond is not 6% anymore. It's not the coupon rate that you're earning, but 3.6%. Okay. On the US Treasury bond, which has a tax rate of 25%, whereas the tax at the capital gains rate of 25%, let's say, the after tax return on the $60 coupon payment that you receive from the US Treasury is $45. So effectively, the return that you're earning on this US Treasury bond is 4.5%. And obviously, if you're given the situation where you can either invest in the Ford bond issue or the US Treasury bond issue, you don't just stop at looking at the coupon rates and say, oh, we are indifferent between these two. That's not true, right? You need to take into account what are the tax implications. The after-tax return on the Ford corporate bond is obviously much lower than what you would earn on an equivalent Treasury bond. So in this case, you're much better off just investing in the US Treasury bond relative to the Ford issue, right? And that in and of itself should tell you that Ford can never get away with issuing a bond issue at the same rate as the US Treasury, right? Because no one will buy Ford bonds if they issue it at this coupon rate. You need to compensate for the fact that there are tax implications to it. So you need to raise this coupon rate sufficiently high enough for you to induce me to switch over from buying a US Treasury and invest instead lending that money to you, Ford Motor Company, right? It's always, as in economics, everything is a game of trade-offs, right? It's not just, you're not the only game in town. You're competing against a wide array of businesses and governments and so on and so forth. And you need to, in order for you to attract capital to your particular firm, you need to make it worth the investors' while to be invested in your firm, right? So that's one thing that usually uh, gets missed in this discussion, and that's why I wanted to spend some amount of time considering these tax treatments. And here it's a quick overview as to what the current climate looks like. So corporate bonds are subject to both state, local, and federal taxes, right? So in the state that you live in, it's essentially the distributions that is treated as part of ordinary income, right? So you get your distribution that gets reported to the IRS when you're filing your end of year tax returns. That gets reported to the IRS, and then you're subject, based on the jurisdictions through which you got those distributions. You might be subject to local taxes, like a city tax, like in New York City, or state taxes, New York state taxes, and also taxes that are owed to the federal government, right? So you have to consider all these tax implications of investing in a corporate bond. A US Treasury bond is not subject to any city or state taxes, so it's exempt from city, local, and state taxation, but it's still taxed at the federal level. Okay. municipal bonds, where you invest in bond issues by small municipalities, right? Small municipalities, small cities and towns need to raise capital to finance public works and investments in public goods that they provide to their governments. But because it's such small jurisdictions, in order to entice investors to invest in these municipal bonds, one lever that the government usually leverages is to make them tax exempt, right? So they're not subject to state or local taxes, and you don't have to pay any federal taxes on them. And that creates, so the municipal bond market is a thriving market. And one reason why investors like to flock to this market is because it's shielded from all of these taxation, right? You can get nice yields on these municipal bonds without having to pay any taxes on them. But the underlying problem is obviously that these municipal bonds are small municipalities, so their default risk is obviously higher than what you would get on a US Treasury bond or a mammoth corporate bond, right? All right. So the primary difference in the tax treatments of bonds, it depends on whether the proceeds from those bond investments are treated as ordinary or wage income, or are they treated as capital income, right? So the two types of income that you get from owning bonds is that you get interest income, right? So these are the coupon payments that these bonds make, that basically, gets deposited in your whatever, in your investment account. But you can just take it out of that investment account, put it in your bank account and spend it as cash. So that's usually in the tax code treated as wage or ordinary income, and is subject to the personal income tax rate that you are assessed at, right? So this is usually going to be much higher, right? Depending on where you're in the income spectrum, your ordinary income tax rates are generally much higher than the equivalent capital gains rate. So that's the second thing. The second way you can uh, uh, profit from investing in a bond is by leveraging on price fluctuation. So if you have a capital gain, in which case the bond price appreciates, and you sell the bond at a higher appreciated price, now you realize the capital gains. This is not because of coupon payments or interest payments from owning the bond. This is just purely capital gains appreciation, and you're assessed at the capital gains rate. The capital gains rate now is about 21% or something around there. So it's much lower than what the personal income tax. The highest bracket of the personal income tax rate is about 39.3%, somewhere around there. And the highest rate of the capital gains rate is flat, it's 21%. So you can see big differences there as well. Okay. The second thing to consider under capital gains is that these taxes are only assessed if they're realized, right? Only if you sell the bond and realize the gains from the price appreciation of the bond do you get assessed at the capital gains rate. Until then, it's all unrealized capital gain. So the bond price keeps shooting up. You don't have to sell it. You can just leave it as it is, and you don't pay any taxes on it. But your wealth is growing, right? At the same time, your wealth, the size of your investment portfolio is growing, and you can leverage it in other ways which are beyond the scope of this class. For instance, you can use it as collateral to open up other lines of credit for yourself at lower interest rates and so on and so forth. Okay. So there's a lot you could do. Okay. So again, to analyze these things, you can see what happens. Suppose the federal income tax rate goes up. Okay. So let's think about what the differences would be between, we'll consider two bond markets again, with the bond market for municipal bonds, which is completely tax exempt, no state taxes, no local taxes, no federal taxes, and the market for treasury bonds, where you don't have to pay state or local taxes on the coupon payments you receive from the treasury bond, but you still are assessed the federal taxes that are owed on this. So suppose the federal income tax rate increases, what do we expect to happen? There's going to be a double whammy, right? First, a higher federal tax rate indicates that there's going to be a lower after-tax return on treasury bonds, because it makes sense. That's what we've already discussed. So the demand for treasury bonds is going to fall, and that's represented by a leftward shift in the demand for treasury bonds. A leftward shift, and if the supply of treasury bonds stays the same, the price of treasury bonds falls, which means the yield on these bonds needs to go up. Okay. At the same time, municipal bonds become even more attractive than they were before, because now with the higher federal tax rate, you're trying to find as many tax havens as possible. And at a higher federal tax rate, municipal bonds have a even even bigger advantage over the equivalent treasury bonds. So you're going to see a upsurge in demand for municipal bonds. So that's represented by a rightward shift in the municipal bonds. So the price of these municipal bonds is going to appreciate, and that means that the market will go into equilibrium for municipal bonds, will go into equilibrium at a lower yield, at a lower interest rate, which is attractive for municipalities if you think about it, right? So if you think through the policy implications of this, you want to increase the flow of money into local governments and municipalities. As a federal policymaker, what is one lever you can pull on? You can raise the tax rate, the federal tax rate. You raise the federal tax rate, treasury bonds become less attractive, corporate bonds become even less attractive. Now, all of this investment capital which is flooding is looking for investment opportunities, and one obvious candidate for this capital to flow into is into the municipal bond market, and it increases the price of these municipal bonds, which means that the interest rate that on these municipal bonds falls, and that is beneficial because to the municipalities, right? Okay, so we talked about the four key things which explain the risk structure of interest rates. One is default risk. That's the most prominent reason. So if the default risk goes up, the demand for these bonds falls, and investors must be compensated for bearing this additional risk. That is to say, the yield on these bonds goes up. If the liquidity increases, what happens to the yield? If the liquidity, so before we go into the second thing, this intermediate step, right? Liquidity goes up, demand for the bonds goes up, demand for the bonds goes up, the market goes into equilibrium at a higher price, market goes into equilibrium at a higher price. What happens to its yield? The yield will fall, right? Because the liquidity profile has improved, investors incur less cost from selling these bonds because they don't have to search around for some place to offload these investments. They can just go into this highly liquid market and sell into that market, and they're done. Information costs go up. What should happen to the yield? Information costs go up. Demand for these bonds falls. Demands for the bond falls. What happens to the price? Price falls. The price of the bond falls. Yield and price move in opposite directions. So yield on the bond needs to go up. Investors need to be compensated because they are spending more time, more resources on understanding the bond to evaluate the bond. Right? Tax liability. Tax liability increases. What do we expect the yield to happen in the corporate bond market or in the treasury bond market? There's a fall in demand, right? Tax liability goes up, the after tax returns on these bonds is decreasing. The after tax returns on these bonds is decreasing, they're less attractive to investors. So you see a leftward shift in the demand curve, bond market goes into equilibrium at a lower price, which means that the associated yield on these bonds is going to go up. Okay. So that's basically the discussion I want to have around the risk structure of interest rates, where bonds which have the same maturity, right? Similar payment structure, same maturity might still differ in the interest rates that they have to offer, right? And the four big explanations we have are concerns around default risk, liquidity risk, the information costs associated with it, and the tax treatment of these bonds. Okay. All right. Now we'll turn to the second part of this discussion, which is the more involved part of this discussion around why bonds which have different maturities have different interest rates, right? So so we are considering bonds which are issued by the same issuer. So there's no difference there in risk profile. Default risk is the same. There's no differences in liquidity because it's the same issuer, the same liquidity considerations are attached to it. There's no differences in information costs. It's the same issuer, no additional information costs. There's no differences in tax treatment. It's the same issuer, treated the same way. So none of that explains it. So these are bonds which are issued by the same issuer, but with different maturities. And just by the timing of when the bond matures, the interest rates on these bonds is going to be different. And we'll talk about three big theories that we have as to what explains these things and where we end up as the dominant explanation, as a more modern explanation of what explains why bonds issued by the same issuer but which have different maturities have different interest rates. So that's what we refer to as the term structure of interest rates, right? So term structure of interest rates refers to bonds which have same uh, characteristics, same underlying characteristics, but only difference between these bonds is that they mature at different points in time. So the most well covered, and this is the yield curve in general, right? Okay, let's just first talk about the yield curve. The yield curve tells us, basically tracks bonds of different maturities issued by the same issuer at which mature at different points in time, right? So it tells us what the interest rate on a bond which is issued by, say, Apple, right? What is the interest rate on a 3-year bond, a 5-year bond, a 10-year bond, a 15, 20, 25, 30-year bond? So it tells us what the interest rates are, and there is a nice little curve which joins all of these things together. But the most important one for consideration as economists is what we call the treasury yield curve. So these are treasuries. So these are issued by the US government. These are bonds which have different maturities. So we are tracking the interest rates of these different bonds which have different maturities, and we join all of these points together. I'll show it to you in a second. And what we get here is what we call a yield curve, right? So here we have a treasury yield curve. So this is the interest rate on a 1-month treasury. This is a yield on a 3-month treasury, a 5-year treasury, a 30-year treasury bond. So we have this relationship, right? This is what we call as a yield curve. So the shape of the yield curve has become a crucial barometer of the health of the economy these days, because a lot of academic research has suggested that the shape of the yield curve gives us an indication as to what is happening in the macroeconomy. It can be a leading indicator which could be predictive of an upcoming recession. Okay, so generally speaking, what we find is that there should be what we expect to see is an upward sloping yield curve, something like this, what we saw on June 16, 2016, an upward sloping yield curve. And this makes logical sense because a 1-month treasury bill is going to pay off very quickly. It's going to make its coupon payments. It's going to mature quickly. The risk associated with it is very, very low. You don't have to wait long. There's no time premium associated with it. You buy it today, next month you get the payment and the face value. You're done. Versus a 30-year bond, it's going to take a long time. It's going to make coupon payments periodically for 30 years, and then it pays off its face value at the end of the maturity period. It takes much longer, so you need to be compensated for the fact that you have to wait for 30 years rather than a month to receive these payments, and so you have a higher yield on those. So that's what we expect to see. Generally speaking, we see an upward sloping yield curve. Occasionally, we might see a downward sloping yield curve. And this is what has called researchers' interest, because the shape of a downward sloping yield curve suggests what? That short-term interest rates are much higher than longer-term interest rates, which is the complete inversion of what we think intuitively should be the case, right? A bond which is maturing in 3 months carries a higher interest rate versus a bond which matures in 30 years. What explains this? The biggest explanation here is that when do bond yields go up? Bond yields go up when the price of the bond falls. Okay, when do prices of bonds fall? When there is a lack of demand for these bonds, right? When demand shifts left and the price collapses, the yield on these bonds go up. When do bond yields come down? When the price goes up. When do prices go up? When there's a increase in demand for these bonds, which means price goes up and the yield comes down. So a downward sloping demand curve suggests that investors are much more apprehensive about the immediate future, the short-term future, than they are about the long-term future. So they are much rather be invested in a long-term, long-dated US Treasury rather than figure out what is going to happen in the short term, which tells us that the financial system might be under some degree of duress because there's lack of confidence in being invested in these short-term bonds. So people go over to the long-dated securities, and that bends the yield curve down. So a downward sloping yield curve, therefore, is usually at least now there is evidence which is starting to add up slowly that it can be predictive of a recession coming on. So we'll get into all of that in a second, but generally speaking, this kind of what we expect to see in the yield curve, a nice little gently upward sloping treasury yield curve, where the interest rate on a short dated treasury is going to be much lower than the interest rate on a longer dated treasury. Okay. All right. And here's a graph where you see what is happening, right? So for the most part, that's what we expect to see: a 3-month bill versus a 10-year note. Both are issued by the U.S. government. Both are treasuries that you can buy. A 3-month bill, obviously, you look through most of the time series, carries a lower interest rate than a longer dated 10-year note. Sometimes that trend is reversed, where briefly the short-term interest rate is higher than the longer-term interest rate. This indicates that this indicates what? This indicates that the yield curve becomes downward sloping briefly, right? This is what that indicates. And we see that during recessions. 2001 we see that, 2006, 2007 we see that. This is the reason. Once you observe this pattern, and this has happened in 1987, so you see every time there is a kind of economic crisis, we see this happen. So this pattern that we observe here is what has caught a lot of academic interest, to see every time we have this kind of reversal where short-term interest rates exceed the longer-term interest rate, or they are very close to each other, which is very, very weird that you see that happening. But like, you see the trend begin to take off much before then. So if we observe this trend strengthening, that might give us an indication that the economy might go into a recession, and there is uh, enough academic research to suggest that this kind of relationship holds up for the most part. The evidence is beginning to weaken these days, because you have this very weird climate where interest rates, the short-term interest rates, are basically close to zero, and the longer-term interest rates are not much higher, and this downward shaping yield curve doesn't hold as much significance, because the pattern is not as pronounced. You're not going to see this big nice upsurge, because these have been depressed. The short-term interest rates have been depressed, as we've discussed, for a long period of time. So the value of using this as a leading macroeconomic indicator is still debatable, but you can see why you would take this into account, that this would be something to consider seriously before doing any other kind of analysis. Okay. The question which has often been asked in this new economic climate that we find ourselves in is that, can the nominal interest rate ever be negative? Right? We've already discussed the case where the real interest rate can be negative. The Fisher equation tells us that the real interest rate is just the nominal interest rate adjusted for inflation. So if the expected inflation is higher than the nominal interest rate, then the real interest rate is obviously less than zero. The more intriguing question is, can the nominal interest rate ever itself be negative? Right? What we find is that during periods of very significant economic distress, right, like during the Great Depression and the Great Recession of 2007, 2009, what we find is that the investors were willing to accept negative interest rates on treasury bills. And the question is, why? Why would anyone in their right mind ever be willing to accept negative interest rate, which basically means you buy this instrument and then you lose money, right? You're not making any profit, instead you're losing money. And the answer is right there. Why would a rational investor willingly accept a negative interest rate? The answer is when the alternatives are much worse. If you're going to lose a lot more money on anything else that you could possibly do, you would choose losing less money over more money. Okay. This entire notion that we have is what we call flight to safety or flight to quality arguments, right? the reason why a nominal, when do you think a nominal interest rate becomes negative is when the price of the bond rises so dramatically, right? The price continues to shoot right up, the interest rate begins to collapse, and at a certain point, the price breaches a level where the interest rate goes below zero. And why would that ever be the case when there's a huge upsurge in demand for a particular bond, such that the yield essentially is evaporated and you go to a zero nominal yield? And that happens when there is periods of huge economic turmoil and there is a massive flight to safety, let's say to default risk free treasury bill, for instance, right? You see this again over and over again in the European crisis in 2012, 2013, that when Greece and Spain, Grexit, and when the Spanish unemployment rate was hovering over 30% at one point, uh, people fled, right? If you wanted a euro denominated government bond, you didn't want to be exposed to Greece or Spain's debt, because the risk of default on those bonds was very high. So what do? You go to the safest euro denominated bond you can find, which is the German bond market, and you flood that market. All these investors who have euro exposure pull out of all the other bond markets, other European denominated euro denominated bond markets, and flood the German bond market. This huge influx of investors into this German bond market makes the price of German bonds shoot right through the roof. The price of German bonds keeps rising and rising and rising. At some point, you're going to have negative yields on these bonds, which means that you're paying money, you're buying bonds which will definitely lose money in a nominal sense. So this, historically, we've always thought that nominal interest rates can never be negative. There's no so-called what we call the zero lower bound argument, because it never makes sense, right? Like, why would any person in their sane mind voluntarily choose to invest money in an instrument which is guaranteed to lose cash, it will guaranteed to yield negative results? And now we have the explanation, right? Now we understand that if the uh, turmoil becomes so pronounced that the flight to safety is massive, then you will end up in situations where you can have negative nominal interest rates. Okay. All right. The last thing that we will do here in this session, and that's the last thing we'll do with this interest rates discussion, is to discuss three explanations for the term structure of interest rates. Okay. So there's three big explanations here, and any explanation that we accept needs to explain three things. Interest rates, the fact you look through the time series, three patterns emerge. Interest rates on longer term, most of the time series. So usually, right? Usually, interest rates on longer dated securities need to be higher than interest rates on shorter dated securities when the issuer is the same, right? The same profile, the same bond issuer. So longer maturity should have a higher interest rate. That's usually what we need to observe. Occasionally, that trend is reversed. So how do we explain that? Whatever theory we put forward needs to account for that. The third thing is that interest rates on bonds of all maturities tend to rise and fall together, that there's synchronicity in how these interest rates move about. And that's what we are seeing, right? So when the short-term interest rate goes up, the long-term interest rate goes up. When the short-term interest rate comes down, the long-term interest rates come down. And there is this correlated movement between interest rates on short-dated securities and long-dated securities. You're going to have that co-movement between those two things. So any explanation that we have which explains the term structure needs to explain these three things. The fact that usually we see an upward sloping yield curve, occasionally we see a downward sloping yield curve. What explains that? And the fact that there is co-movement, that the short-term interest rates and the long-term interest rates tend to move in the same direction, right? If one falls, the other falls. If one goes up, the other goes up. Okay. Three theories. We'll take each of these in turn. The first one is what we call the expectations theory. The second thing, which is called the segmented markets theory. And the third thing, which is called liquidity premium or the preferred habitat theory. So we'll take each of these in turn and discuss what the explanation is in each of these cases. Okay. The expectations theory is fairly straightforward. The expectations theory tells us that the long-term interest rate, the interest rate on long-term bond is just the average of the interest rates of all the short-term bonds which are in the intervening period, right? The assumption is that a 10-year bond, you can mimic the return on a 10-year US Treasury by basically investing in 10 one-year maturity US Treasury bonds. So what do you do? So you can go into the market and buy a bond which matures in 10 years, or you can go into the market and buy a bond which matures in 1 year. When the bond matures, you take the proceeds from that and then invest it in for one more year in the same bond. Then once it matures, you take that and you do this over and over again. This is the crucial term here, is that bonds of different maturities are treated as perfect substitutes for each other, that you can mimic, you can basically mirror the return on a 10-year bond by using a series of shorter dated securities. So instead of being invested in a 10-year treasury bond, instead of buying that bond issue, you can buy two 5-year treasury bonds, maturities of 5 years. So after the first bond matures, after 5 years, you take that money and invest it for another 5 years, and the yield that you should get should be the same, right? So that tells us that the expectation theories hold, that the interest rates uh, on longer dated security is just the simple average of the interest rates on the short-term bonds over the lifetime of the long-term bond, right? So otherwise, what happens if that's not the case? Otherwise, you have an arbitrage opportunity here. Okay. Simply put, if there's a difference between those two things, so suppose on a 10-year treasury bond, you can earn 10%. If by investing in a series of shorter dated securities, if you can earn more than 10%, now we have an arbitrage opportunity. Okay. Now that can't be the case, because if markets are efficient, you shouldn't be able to arbitrage that, because nothing fundamentally is different between these two things other than just the timing, but you're also matching the timing, right? It's still the same maturity. So if under no arbitrage conditions, these two strategies, the buy and hold strategy, where you buy a long dated security and hold it till maturity, and the yield on this rollover strategy, where you buy a series of shorter dated securities, should converge, should be the same, right? So we are considering a discount bond, very simple case, so we can ignore the coupon payments for now. Even if you add in the coupon payments, the analysis is the same. So you have two strategies that you have. Okay. You are investing $1,000 for 2 years, and you are considering two strategies. The first strategy is the buy and hold. So you go into the market, buy the bond which matures in 2 years for $1,000, and that's it, right? So if you do the buy and hold, so after 2 years, the $1,000 investment would have grown to $1,000 times 1 plus I2T times 1 plus I2T. This is just expressed in yearly terms. So it's $1,000 times 1 plus I2T squared. Okay, that's basic. We know this to be true, because at the end of the first year, you earn this much interest rate. So the interest also earns interest. So at the end of the 2 years, you'll have $1,000 times 1 plus I2T times 1 plus I2T, where I2T is the interest rate on the bond which matures in 2 periods, in 2 years, right? The rollover strategy, what is the rollover strategy? The rollover strategy is that you invest in two 1-year bonds, right? So on the first 1-year bond, you know what the interest rate is going to be, because the coupon payment is predetermined, right? You know what the interest rate is. So you take your $1,000, you invest it for 1 year. At the end of the first year, you'll have this much money, $1,000 times 1 plus I1. Now you take that money and invest it again for another year at an expected interest rate that you think will prevail in the following year, 1 plus I1T plus 1, which says that it's a 1-year maturity bond which matures in, starts at time period in T plus 1 in the next period. Okay. So these are your two strategies. Either you go the buy and hold strategy, where you buy the 2-year bond, hold it till maturity, earn this much money, or you do this rollover strategy where you take your $1,000, invest it in a bond which matures in 1 year, take the proceeds of that investment. There is no confusion around what this I will be, because that coupon rate is set and you know what that'll be. But the following year, you have an expectation on what the interest rate should be. Okay. Under no arbitrage conditions, these two should yield the same thing. I should end up with the same amount of money in either case. If I end up with different amounts of money, there's an arbitrage opportunity because it's the same issuer, and I can uh, we'll discuss the arbitrage opportunity which arises here. But under no arbitrage conditions, under efficient market conditions, you should end up with the same amount of money in both cases. So $1,000, this is what you get from the buy and hold strategy. This is what you would end up with in the rollover strategy. These two things should be the same, which tells us that I2T, right? If I simplify this, you can go ahead and simplify this. This tells us that I2T is just I1T plus I1, the expected interest rate in the following year, the interest rate in the first year plus the interest rate in the second year divided by 2, which is just the average of these two short-term interest rates. So based on this theory, what we say here is that the expectations theory says that the interest rate on a 2-year bond should just be the average of the interest rates that you would earn on 2 1-year bonds that you can leverage. So for an N-year bond, the interest rate should be just the average of all the short-term interest rates in the intervening N years, right? So the interest rate on a bond which matures directly in N years time from now should be the same as the interest rate of each of these 1-year bonds that I can use to mimic that structure of that bond divided by N, which tells me that's just the average. Okay. So here's an example as to how we infer what the expectations on interest rates are in the bond market. So suppose I1T is 2%. So I1T says that this is a bond which matures in 1 year from now, and the interest rate on that is 2%. This is a bond, I2T. This is a bond which is starting today, will mature in 2 years, and it carries an interest rate of 3%. What is the expected 1-year rate, right? So after 1 year, what do you expect the interest rate to be in the second year? So the interest rate at the end of the 2 years is on a 2-year bond is 3%. We know that the interest rate on the first year is 3%. The interest rate on the first year is 2%. So if you plug that in, so I2T is I1T plus I1 expected T plus 1 over 2. So if you back that out, you expect that the interest rate in the longer term, in the second year, is going to be 4%. So the average, the blended interest rate between those two, the average of those two is going to give you the longer dated interest rate of 3%. Okay. So the expectations theories holds that the longer dated security, all these shorter dated securities are perfect substitutes for the longer dated securities. So in the sense that this buy and hold strategy and the rollover strategy, under no arbitrage conditions, you should end up with the same amount of money, which tells me that the longer dated interest rate is just the average of the shorter dated interest rates. Okay. Which tells us that based on the theory, what is the explanation? The explanation is that the upward sloping, the usually what we see as the upward sloping interest yield curve, is because people are expecting that future short-term interest rates are going to be higher than current short-term interest rates. Okay. If you're going to have this upward sloping feature, okay, so if I'm going to have this upward sloping feature, what it means is that the interest rate I expect to earn from year 1 to year 2 will be higher than the interest rate I expect to earn in year 1, right? That's the only way I can get up to this point, right? Because for this average to rise, the second number needs to be higher, much bigger than the first number for the average to hit this point. So we've seen this example here. For the average of these two numbers to be 3%, where the short 1-year interest rate is 2%, but the 2-year maturity interest rate is 3%, then the expected interest rate in the second year needs to be higher than either of these two numbers for the average to converge to 3%, right? So an upward sloping yield curve, the explanation is that investors are constantly expecting interest rates to rise, so short-term interest rates to keep rising, and that's why you get this upward sloping interest rate. Okay. You get a flat yield curve when investors are expecting future interest rates to be the same as the current interest rate. Okay, so that if you are going to see a flat interest rate, that's what the expectations theory says. That, oh yeah, that's just basically because what investors are expecting is that the interest rate's not going to change all that much. A downward sloping interest rate happens when the expectation is that the future interest rate is going to be lower than current interest rates, right? That future short-term rates are going to be lower than the current short-term rate. So all of the explanation for the shape of the yield curve is driven by what we infer to be the expectations of the investors about future short-term interest rates. If the expectation is that future short-term interest rates are going to be greater than the current short-term interest rate, then we should see an upward sloping yield curve. If the expectation is that the future short-term rates are going to be are going to be the same as the current short-term interest rate, then we see a flat yield curve. And if the expectation is that the future short-term interest rates are going to be lower than the current interest rates, then we should see a downward sloping interest rate. Okay, and that's basically what we are what the expectations theory is suggesting. So these three kinds of curves. What is the problem here? The problem here is that the dominant explanation for an upward sloping yield curve that the expectations theory offers is that investors are constantly forever into the future expecting short-term interest rates to continue to rise and rise and rise and rise. But interest rates are liable to fall as much as they're going to rise, right? But the yield curve is typically upward sloping. The suggestion is that the investors' expectations are always that short-term interest rates are continuing to rise. But if you think about the interest rate is determined based on supply and demand in the bond market. So if the demand dries up, then the interest rate will go up. If the demand goes up, the interest rate will fall. And we can't predict that with any accuracy. So it's equally likely that the demand goes up as it is that it'll go down. So this explanation that, or 30-year bonds interest rate is just the average of intervening 1-year maturity bonds for 30 years kind of lacks that oomph, right? You don't get the full explanation there because this doesn't seem like a very logical way that people think. Okay. So the expectations theory, while it's kind of an elegant explanation of why you would have an upward sloping interest rate, kind of fails to pass muster in any reasonable sense, right? Because all it's saying is that investors' expectations are that short-term interest rates are always going to rise into the future. Why? That's not explained. Okay, and now you have a problem. Okay. Actually, yeah. So I'll come back. No, no. Okay. Let me just come back to this in a second. Once we've actually dealt with uh, the other two theories, because I'll keep those two things together, and then we'll come back to what the carry trade has to say to all of this. Okay. The second big explanation for the term structure of interest rates that we have is what we call the segmented markets theory. The segmented markets theory basically relaxes the two foundational assumptions of the expectations theory, right? The segmented markets theory says that investors in the bond market do not all have the same objectives. So there's no homogeneity among investors. That means that the expectations of different investors are going to differ. So there's no common expectation from all investors. So there's no homogeneous beliefs there. The second key assumption, the more key assumption that gets relaxed here, is that these bonds of different maturities are not perfect substitutes for each other. That there's the assumption that investors view bonds of different maturities as perfect substitutes, that you can do a rollover and a buy and hold and they are both the same thing. That's not okay. A segmented markets theory says that the bond market is not a monolith. Investors who want to buy a 1-year maturity bond are not the same investors who are in the market for a 30-year bond. These are completely different types of investors who participate in these markets, which is to say these are completely different markets, that these markets are quote unquote segmented. Okay. So the segmented markets theory says, first of all, that there's no homogeneity in beliefs amongst investors. The second thing it says is that these bonds are not perfect substitutes for each other. The third thing it says is that these bond markets are separate markets. There's no monolithic bond market where all of the same investors participate in a market for a 1-year maturity treasury bond versus a market where of investors who want a 30-year maturity bond. That these are separate classes of investors, and what happens in one market and what happens in the other market is determined by supply and demand in those individual markets, right? What happens to the interest rate on a 1-year treasury bond is determined by supply and demand in the 1-year treasury bond market. What happens to the interest rate in a 30-year bond is determined by the supply and demand in the market for a 30-year bond. Okay. So the segmental markets theory says, compared to short-term bonds, obviously long-term bonds are subject to greater interest rate risk. Okay, they're much less liquid to begin with. First of all, short-term bonds are much more liquid, right? The trade in the short-term bond, if you look at the volume of trade in a short-term bond market relative to a long-term bond market, the volume of trade is much higher in the short-term bond market relative to a long-term bond market, which suggests that there's more liquidity in the short-term bond market. More liquidity suggests that short-term interest rates needs to be lower than a long-term interest rate. So that's one explanation for the differences in liquidity between these two markets. Okay. So the yield curve, the explanation based on the segmental markets theory is that if you think of these bonds as being two separate, of all these different markets we segmented, then the interest rates in the short-term bond market is going to be lower than the interest rate in a long-term, longer dated security bond market, because the short-term bond market is much more liquid. There's many more participants in the much more liquid market than the long-term bond market. Okay, so that's their explanation for why we see an upward sloping yield curve, because the short-term bond market is more liquid. Because it's more liquid, the yield in that market is lower, the interest rate in that market is lower relative to a longer dated bond market, in which case the yield needs to be higher in order to compensate for the fact that there's more risk from waiting for 30 years for the bond to pay off versus the amount of risk that you carry on a 1-year bond. The big problem here, of course, is that it doesn't tell us why the yield curve sometimes is downward sloping. Because based on this, there is no explanation for why the yield curve is downward sloping. The other shortcoming is that it doesn't tell us why there is this co-movement. If these are all separate markets and the interest rates are determined separately, why is there this correlation between interest rates? Why does one interest rate, when one interest rate goes up and the short-term interest rate goes up, why does the long-term interest rate also go up? When the short-term interest rate falls, why does the long-term interest rate also fall? Why is there this correlation between these two markets when your theory is saying that these markets are separate, that they're segmented markets? If they're segmented markets, there should be no correlation, but that's not the case. Okay, so the segmented markets theory, while interesting, and again, a nice little explanation of why interest rates are different in different markets, is a very elegant explanation in the sense that, and intuitive. It says that interest rates are different in markets for different maturities because they're different markets. Right? It basically turns the question on its head. It's kind of a circular argument. Okay. All right. The last theory then is to consider what we call the liquidity premium theory, or what we sometimes refer to as the preferred habitat theory. Okay. So what does the liquidity premium theory tell us? Okay. Liquidity premium theory extends the expectations theory, but adds in this new term, which is known as the term premium. So the liquidity premium theory says that, yeah, the longer term interest rates is going to be the average of the short term interest rates, but that's not just it. There's also going to be a term premium, and the term premium exists in order to compensate investors for the fact that they have to wait a long time for them to receive their money, right? Because a longer dated security, because it has a long maturity period, you need to compensate for the fact that there is a longer maturity period. And so there's an additional term premium on top of the average of the short-term interest rates that you need to pay in order to entice investors to invest in the longer dated security versus shorter dated securities, comparable sequence of shorter dated securities. And it makes a lot of sense. Why? If I have the option, consider this, I have a 30-year bond which has an interest rate of 10%, versus I can earn the same 10% return by buying a series of 1-year maturity bonds for 30 years. Why would I ever venture into the 30-year bond market? I get the same return, same risk profile, same return, but I have the additional liquidity. Every time the cash keeps coming back, coming to me, and I don't have to carry the risk of what happens in 30 years on my balance sheet. I only need to account for the risk of what happens in 1 year on my balance sheet, and I'm getting the same return. So you would not have a market for 30-year bonds at all then, unless there is an additional premium that I receive, additional interest rate that I receive, in order just to compensate for the fact that I have to wait a long period for me to see a return to that investment. And that's basically what they do. So the extension here is that the interest rate on a bond which matures in 2 years is going to be the average of the interest rates on 2 1-year bonds, the interest rate that you get in the first year plus the expected interest rate that you earn in the second year divided by 2. That's the average. That's what the expectations theory, plus an additional term premium. The TP here represents term premium for having to wait for 2 years to receive this bond, to receive the payments on this bond. Okay, so for an any year bond, it's just the average of the intervening short-term interest rates, the average of the intervening short-term interest rates, plus an additional term premium on top. Okay. So here's the story. So suppose we have to calculate liquidity premium. So 1-year bond, a bond which matures in 1 year has 1.25%, a treasury bond, a treasury bond which matures in 2 years has a 2% interest rate, and a treasury bond which matures in 3 years has a 2.5% interest rate. Okay. Based on this, given that the term premium on a 2-year treasury note was 0.2% and the term premium on a 3-year treasury note was 0.40%, what is the expectation on the interest rate on the second year, and what is the expectation on the interest rate in the third year? Okay, so I2T here, if you just plug everything in, the interest rate on the 2-year bond should be the average of the interest rates in the first year, which is 1.25%. We know that, plus the expected interest rate that I would receive in the following year divided by 2. That's the average of those two, plus the additional term premium, which I said was 0.2%. Okay. So based on this, the expectation is that in the second year, the interest rate should be 2.35% to get a 2% interest rate on a 2-year treasury bond, given that the term premium is 0.2%. So you can just run the math on this. If this is 2, this is 0.2. So you take that over, that would be 1.8. So multiply by 2, that's 3.6. 3.6 minus 1.25 is 2.35%. Okay. Similarly, if I had to find it for a 3-year bond, now that I know that the expectation on the second year is 2.35%, now I plug it in for a 3-year horizon. On a 3-year bond which matures in 3 years, which has a 2.5% interest rate, the first year's interest rate is 1.25%. The expected interest rate in second year is 2.35%, which is what I calculated here, plus the expected interest rate in third year divided by 3. That's the average of those 3, plus the term premium 0.4%. So I run the math on that, and that's 2.7%. Okay. So the 3 theories that we have: expectations theory. Expectations theory says that investors have the same investment objectives, that they have the same homogeneous beliefs, that they treat different bonds with different maturities as perfect substitutes for each other. So a 5-year bond is the same as 5 1-year maturity bonds. And it says that the interest rate on the 5-year bond is just the average of the short-term interest rates. Okay. It explains the slope of the yield curve. It tells us why short-term and long-term interest rates move together, but does not explain why occasionally we see the yield curve invert. The second theory is the segmented markets theory, which says, no, 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 these bond markets are not perfect substitutes for each other. Investors in one market are not the same as investors in the other market. So whatever happens in each market, whatever determines the interest rate in each market is driven purely by supply and demand dynamics of that market. There's nothing to do with anything else. And that explains why the yield curve would be upward sloping, because liquidity, right? Because there's a lot more liquidity in the short-term bond market than there is in the long-term bond market. So consequently, the yields in the short-term market are lower than the long-term bond market. And that explains why the yield curve is upward sloping, but it doesn't tell us why occasionally we see a downward sloping curve and why these interest rates seem to move together. The liquidity premium theory says, yes, the explanation from the expectations theory is sound but incomplete. It's not just that the long-term interest rate is just going to be the average of the intervening short-term interest rates, but there is also this additional thing that we will call the term premium, in order to compensate for the fact that the longer dated securities carry more risk with them. And so the investors need to be compensated a bit more in order for them to be enticed to enter these markets in the first place. Okay. So the preferred theory these days is the liquidity premium theory, because it explains all facets of it. It tells us why short-term interest rates are usually lower than long-term interest rates. Okay. It tells us why we would see an upward sloping curve. It's based on expectations. It also tells us why there is an occasional uh, the term premium explains why the markets exist, why both the market for a 1-year bond exists as simultaneously when a market for a 30-year bond exists. Both of those markets are not, the bonds are not perfect substitutes for each other. It also explains why occasionally we see a downward sloping yield curve. Okay. We've already talked about this as to, can the term structure predict recessions, right? That we find that the yield curve is a useful indicator for predicting recessions. And this term spread that we find between shorter dated securities, the usual one which is observed is the 210, which is the difference between the interest rate on a 2-year treasury bond versus the interest rate on the 10-year treasury bond, right? That's what is usually we're looking at that, and we expect that to be negative, right? The interest rate on a 2-year bond should be lower than the interest rate on a 10-year bond. But if that becomes positive, then the curve is downward sloping, and during recessions, interest rates typically fall on short-term securities. And if there's a massive flight to safety, there might be a huge upsurge in demand for longer dated securities, in which case that entire dynamic is shifted, right? It's reversed, and you would see a downward sloping yield curve. Okay. So generally speaking, we live in this world. When a crisis is forthcoming, we might see a structure like this, where, and again, we see this here as well, right? Where the longer dated securities, where the shorter dated securities have a higher interest rate than the longer dated securities. So this is basically where there's an inversion in the yield curve. And for now, the research is still going on. So if you're interested in this, there's a lot of interesting macroeconomic research that goes on uh, in considering whether whether there is a correlation. There's no doubt. There's a correlation between when these interest rates, when the yield curve becomes downward sloping and the recession. Those are correlated, and there's a strong correlation between those two. But are they predictive is a question. Are they happening simultaneously, or can we look at the term structure of the interest rates to give us a solid indication of that the economy is impaired? Okay. All right. Okay. The last thing is about ratings agencies. Given how poorly ratings agencies conducted themselves during the 2007-2009 crisis, the question still remains: should these ratings agencies, where they're paid in order to rate these bonds, right? So Moody's, Fitch, and S&P are not non-profit or government agencies. So if you want to issue a bond, you go to one of these ratings agencies and tell them, so this is the bond we want to issue. These are our underlying financials. Whatever, give us a grade on this bond. issue. Okay. The question still remains whether this should be a for-profit business because the incentives are misaligned, right? Right. If you're Moody's and it's in your interest to serve your client, the client wants a AAA rating because that will get a lot of demand for that bond. It also means that the yield, the interest rate they have to pay on this bond issue is low, so their incentive is to get as high a rating as possible. And given that they are the party which is paying for these bonds to be rated, that gives them a perverse incentive to pay these ratings agencies to look the other way and issue a higher rating than they otherwise would get. And this is ongoing policy debate, and depending on where you land up on this debate, there is some more than reasonable suggestive evidence that perhaps these ratings agencies should be more closely regulated. Or perhaps there should be, these ratings need to be given out by an independent body which is not financially incentivized to provide, inflated ratings, right? So, there's arguments on both sides. Again, subject of ongoing research. It's something to consider. Okay. Before I end, I just want to briefly go back to this one thing that I skipped over here about this, what we call the carry trade. Okay. The carry trade is a very interesting idea. It essentially starts from this observation that the yield curve is usually upward sloping. What does it mean? The yield curve is upward sloping suggests that short-term interest rates are lower than long-term interest rates. Does it give you an idea for an investment philosophy? If you can borrow at the lower short-term interest rate, okay, and then invest in the market for longer dated securities which carry a higher interest rate. So you're borrowing, so suppose the short-term interest rate is 2%. So you raise money. So let's say you raise $100 million, you issue a bond and the interest rate is 2% on that bond. Okay. You take that $100 million that you borrowed, not do anything with it, just go and buy a 30-year bond which yields 4%. Okay. Now you have a carry trade because once that bond pays off in 30 years, what do you have? You essentially pocket that spread. That 2% that you get is the compensation that you receive from carrying out what is known as a carry trade, right? So interest carry trade essentially refers to borrowing at low short-term interest rates and using the borrowed funds to invest at a higher long-term interest rate. What is the problem with this? Can you do this as an individual investor? Can you do it as an institutional investor? Should you consider doing this? The initial explanation seems straightforward. Upward sloping, usually the yield curve is upward sloping, which suggests that, okay, I should borrow at the short-term interest rate. I can go invest this money in a longer dated security and pocket the spread. Okay, and the carry trade is profitable. But for the average retail investor, can you and I go leverage this strategy? The problem is that no one is going to lend to us at the short-term interest rates. We can't just go float a bond at a 2% interest rate on the bond market and expect people to lend us money at 2% interest rates, right? It's really, for a retail investor, interest rates are much higher because the risk profile of a retail investor is much more severely adverse relative to a big corporate behemoth which is doing this, an institutional investor doing this. So a carry trade as a strategy for investment for a retail investor is basically not an option. So, okay. So then what about an institutional investor? An institutional investor is very large. They can access this interest rate, these low interest rates, because they are very large investors. They can borrow money at such low and short-term interest rates. So carry trade is feasible. To begin with, yeah, they can borrow at that interest rate. But what seems to be the problem? If the expectations theory is correct, what does it suggest? That whatever you will keep borrowing at this short-term interest rate, but the long-term interest rate is just the average of all the short-term interest rates. So even though you're borrowing at a short-term interest rate for now, in the long run, because the expectations is that the future interest rates are going to continually rise in order for the long-term interest rate to be where it's at, you'll continuously increase the cost of borrowing. You'll keep the cost of servicing the debt keeps going up and up, and in the end, it's going to be a wash. Right? There's no profitable trade to be had because arbitrage dissipates, because the expectation that people form on future interest rates is that it'll be higher and higher. So which means that that arbitrage opportunity dissipates, and there might not be a case where you can make a successful carry trade. One particular case where this carry is actually quite a good option, which investors have successfully leveraged in the past, is when the yield curve is inverted. When the yield curve is inverted, what does it mean? When the yield curve is inverted, you borrow money at the long-term interest rate, which is lower now. So suppose the long-term interest rate is 5%, you issue a 30-year bond and borrow money at 5%, suppose $100 million issue at 5% 30-year interest rate, whatever. And then you have the $100 million and you take that money and invest it in the short market, okay, in the short maturity market. Now you can, if you do that, earn short-term interest rates. You can, now it's a successful carry trade because now you can, so if the short-term interest rate is 7%, now you'll earn the higher interest rate for that year. Problem is that every year you have to service that debt, the 30-year bond that you invested at a 5% interest rate that you borrowed. You need to keep servicing that debt, which means that the short-term interest rate in any given year can't fall below 5%, because then you'll be underwater, right? Because your liabilities are that you need to at least service 5% coupon payment every single year on that long-term bond issue that you did. But interest rates, if they fall below 5% at any given point in time, you're not earning sufficiently high enough returns for you to successfully get this carry trade through, right? So this is what we call reinvestment risk. The risk that the interest rate on new short-term investments will decline after the short-term investments mature. So for the 1 year bond which pays you 7%, that 1 year you will make a nice profit because you borrowed at 5%, invested at 7%, you'll make a nice profit. But the second year you need the interest rate to be still high. If that goes down, then you're in trouble and you are faced with a massive reinvestment risk on your hands. So this carry trade, while it's very intriguing and some investors have successfully carried this out, it's a very sophisticated investment strategy which needs very precise timing and very um, um, accurate assessment of where interest rates will be, right? Suppose not a 30-year thing, you can carry this out on a much shorter basis, right? So a 5-year bond you issue at a, when the yield curve is inverted, you issue a 5-year bond and borrow at a lower long-term interest rate. And then hopefully in the short run, the interest rates, if the markets remain turbulent and volatile, the short-term interest rates stay consistently high and you can clear a nice profit in the intervening period. You can do that. Or you can take the strategy even further, and instead of investing in a 1-year maturity bond, you basically borrow at the 1-year interest rate and invest in higher 3-month treasury interest rates, and then hopefully you can capture some of that spread. But it's a very dicey process because at any given point in time, if interest rates fall, and if the yield curve instead of staying downward sloping, if it reverts course, becomes flat, or much worse, becomes upward sloping at any point during this process, you're in severe trouble because the reinvestment risk is very real in that case, right? All right, so that's basically all I want to do in this session. Hopefully this was clear. This is the last thing we want to talk about around interest rates. So if there's any questions, as usual, leave them in the comments below the video or send me an email, see me in office hours. I hope this discussion was clear and interesting. Thanks everyone for listening, and I'll see you in the next one. Bye-bye.